This is part 1 of an introduction to finance and financial markets, so our first topic. And in here we're just going to be taking a look at, first of all, the objective of a firm and how that translates to the objectives of shareholders. Then we're going to just take a look at some of the features of a corporation and look at what's known as the agency problem. So first of all, the objective of a firm. So the objective of a firm is pretty simple. It's just to maximize value. And note that value can be thought of as a market capitalization, which is just our share price times our number of shares. So we'll look at that later on in the course. It's sort of a recurring theme, a market capitalization. But it's a pretty simple concept. It's just the number of shares on issue either for the market as a whole or for the particular company, and the share price attached to those shares. Note also that value is a long-term measure, so it's more like wealth. It's not a short-term measure such as income. So what is the objectives of shareholders? So note that value is simply something that, although it is quantified somewhat, it's very much determined by what shareholders think of the company. And the reason why, even though it's quantified, it is that the share price is affected on how people perceive a company. If you perceive a certain stock quite well and you intend on buying that, other people will also share that opinion, and that the increased demand will drive the share price up. So it's a subjective sort of measure value. And therefore, in order for the firm to maximize value, which is its objective, it should aim to meet the objectives of the shareholders, because if the objectives of the shareholders are met, it's going to drive up value in their eyes. So first of all, it's maximizing wealth, so the long-term measure of income basically. And this wealth is going to be distributed in some sort of time pattern of cash flows. So some stocks may have a lot of short-term cash flows and some might have long-term cash flows. We've got to take into account in here the time value of money, which we'll look at during financial mathematics, which is simply just that because of interest, $1 today is always worth more than $1 tomorrow. But it's also got to do with a lot of personal factors. So someone who is investing for maybe their retirement won't look at sort of short-term cash flows, they'll look at the long-term cash flows. So it's about obtaining the most desirable time pattern of cash flows, both taking into account general financial mathematics and also due to personal desirabilities. And finally is to manage the risk characteristics of any cash flows. So any sort of stock is going to have some sort of risk attached to it, which we'll take a look at during the risk topic. But basically what anyone wants to do is to balance that risk and return that you get from a particular security. So it's to manage the risk characteristics, and again that's very personally dominated due to personal preferences. Someone may want higher risk characteristics, someone may want lower risk characteristics. So now we're just going to take a look at some of the features of a corporation. And you can see that the first one is that a corporation will have an unlimited life. So if we sort of think about a company such as BHP compared to maybe a company that you just start, with a corporation, because you've got shares on issue and that's determining the ownership of the company, the corporation's going to live on forever. It's got an unlimited life. Whereas if you open up a business tomorrow and then in 20 years you die, the company ends with you. So that's the difference between a sort of corporation and just another type of business. The other is that it has the ability to transfer ownership without affecting normal business operations. So again, if with shares, so such as BHP, someone could sell their share and another person could buy their shares, and it's not going to affect normal operation, day-to-day business. However, if you were to open up your own business and then you were to transfer the ownership to someone else, it's going to affect normal business operations. And the reason for that is due to another characteristic that we'll look at. But the third is limited liability. Now, what limited liability means is that the owners of the corporation won't have to meet the debts of the corporation itself. So if you were to open up a business and you were to get into a lot of debt, even if the company itself couldn't pay those debts, you would be liable for those debts as owner. And that's what we call unlimited liability. In a corporation, if a corporation goes broke, the debts of the corporation will only be met by the corporation itself. So once the funds have gone, the owners or the shareholders don't have to then open up their pockets to pay the remaining debts. It ends with the corporation, so it's limited. And finally is the separation of ownership and management. And this is really why this occurs. So the ownership of a corporation is the shareholders, and management is separated from that. So if you were to open up a business, you would normally be running it as well as owning it, whereas in a corporation that doesn't exist. And that's normally why you can transfer ownership without affecting normal day-to-day business, because management is unaffected by the ownership. But it's this problem, the separation, that causes what we call the agency problem. And this is basically that occurs when managers don't act in the best interest of shareholders. So because they don't own the company, they may start acting in their own best interests rather than the interests of that of the company, and therefore the interests of the shareholders. So a classic example of this would be in the case of a takeover. Normally in a takeover, the management will no longer be management. So they'll have a refresh, new management come in. So therefore, if there's a threat of takeover, even though it might be in the best interest of the shareholders, if the company's not going that well, management may try to resist the takeover because they know it'll be a loss of their jobs. So we've got the example takeover. Now, agency costs are those costs to monitor managers and constrain their actions in order for them to act in the best interests of the shareholders in the company. So an example of this is annual reports. So the cost of producing these annual reports is what's known as an agency cost, because annual reports add a level of transparency for management actions to the shareholders. So whatever they've done and the effects that has had on profit and all the things that shareholders look for when investing becomes transparent in an annual report. And therefore it's a cost that shareholders have to monitor the managers and therefore constrain their actions. There's many factors which reduce the agency problem that we see in businesses. So one is legal and regulatory requirements. So that's things like that companies have to produce annual reports and things like that. The second is many companies have top management compensation plans linked to shareholders' goals. So they may have as part of management compensation plans, you may have shares. So therefore they sort of become part ownership, and their compensation will therefore be impacted on how well the company performs. So things like profit and everything like that. We may also have a board of directors representing shareholders. So the board of directors will approve major decisions and reject things. So that sort of adds that extra level of that managers sort of have to answer to. In addition, most corporations are monitored by security analysts, which then make advisements to shareholders on whether to buy or sell. And they can see if a company is being managed properly, and therefore, if it's not, they can say to sell those shares, and that's something that management doesn't want. There's also the threat of takeovers and shareholder pressure. So if the managers aren't acting in the best interests, you'll normally have these threat of takeovers and shareholder pressure in order to do so.